Very good morning, friends. Let's quickly take a look at one question from May 24 Mark 1 question because it is a combination of Ind AS 21 and Ind AS 109. So let's quickly get going. An Indian entity whose functional currency is rupees purchased a dollar denominated bond at its fair value of USD 1000. The bond carries stated interest at 4.7% per annum on its face value. The said interest is received at the year end. The bond has maturity period of 5 years and is redeemable at its face value of $1250. The fair value of the bond at the end of year is $1060. I repeat, I highlight. The fair value of the bond at the end of the year one is $1060. The exchange rate and the rate of transaction at the end of year one are $1 is equal to rupees 40 and $1 is equal to rupees 45 respectively. The weighted average exchange rate for the year one is $42. Entity has determined that it is holding the bond as part of an investment portfolio whose objective is met by holding the asset to collect contractual cash flows and selling the asset. The purchased dollar bond is to be classified under FVTOCI category. So the bonds EIR, that is effective interest rate, is 10%. Calculate gain or loss to be recognized in P&L and OCI for year one. Also pass journal entry to be recognized to recognize the gain or loss of the above. So this is the question. Nice question. Let's quickly get going. So if we see the cost of the bond, first is given, the exchange rate is also 40 given. So if you do that, so that will come to 40,000. And when you accrue the interest at 10%, be very careful. The rate to be used, weighted, that is why I specifically highlighted this. The weighted average exchange rate is $42. So at 10%, so 42, that comes to 4,200. And interest received, that is 1250 into 4.7%, and the rate now to be used is 45 rupees, and that comes to your that will give you the interest received amount as rupees 2,655, and the amortized cost at the year end will be 46,845 rupees, and fair value at the year end, that is 1060, that again I highlighted for you. If you can see the fourth line of the para, so 1060, that should be again at the year end rate, that is 45 rupees. So 47,700, and interest income to be recognized in a P&L is 4,200. So exchange gain on the principal amount, that will be the difference between 45 and 40 into 1000, that will give you 5,000. And exchange gain on interest accrual, that is the difference between 45 and 42. The principal amount is 45 and 40. Here it is the difference between the closing rate and the weighted effective rate. So that will give you 300. So total exchange loss to be recognized and P&L will be 5,300 rupees in INR. Now fair value gain to be recognized in OCI. So that is the difference between the fair value at a year end and amortized cost at year end, that is nothing but 1060 minus 1041 into exchange rate 45 rupees. That will give you rupees 855. So now if you do till year, 4 marks will be secured. If it comes for 6 marks, now the journal entry to recognize the gain or loss will be bond. So that is 47,700 minus 40,000. That will give you 7,700. That is nothing but, if you can see, the fair value year end minus cost of the bond. And the bank, the interest receipt that we just computed in the third one, the interest receipt 1250 into 4.7% into exchange rate at 45 rupees. So that is nothing but 2,655. To interest income 4,200, to exchange gain, that is nothing but the difference between 5,000 and 300. So 5,300, which we saw the P&L amount, the gain realized, and to OCI fair value gain rupees 855. That is it. Straightforward question, but a bit of application is required regarding which rate to be selected, and also the computation aspect. So once you listen 2 to 3 times, it will be very easy for you. So keep going. Best wishes and all the very best.